Hi everyone. I wasn't going to make this video, but essentially I made a video earlier and I showed a strategy that would have beat Buffett's returns. Now Buffett's very popular. He had a decent return over quite a long period of time, and there's a strategy that would have beat that. Now it's a proven strategy over nearly a century. There's no capital limitations. It's not penny stocks, none of that. So I'll show that later in the video, but essentially it ties into leverage ETFs. Now the reason I'm making this video is because I received a couple interesting comments and I thought a lot of people may have the same misconceptions about leverage ETFs. They may just be a little bit ignorant. I don't mind clearing that up, so I'm going to first go over the misconceptions and then explain how they're all false. So a quick Google search. Can you hold leverage ETFs for the long term? The answer you're going to get is basically no. And there's many reasons. Decay, short-term focus, volatility. 3-time ETFs are risky. They're not appropriate for long-term investors. There's the decay risk. Okay? So with this being the Google search, obviously people are going to believe this. This is what they're going to come by. This is common knowledge. It's quite interesting because this knowledge is all false, and I can show you the facts and the data to prove it. Now, if these facts for some reason don't convince you, I really don't know what else to say, but I'll get into that now. So the first fact, this guy left me a comment and said, you cannot hold leverage ETFs overnight as it is a mixture of futures and options. You will lose money every single night as the funds reset. Guys, if you held TQQQ, a leverage ETF, since its inception, you would have made a 16,300% return in 15 years. I don't know what losing money every night means, but this is certainly not losing the money. It's murdering the market, for one. And two, if you guys have ever held a leverage ETF like myself overnight, you don't just instantly lose money. So the idea, it can't be held long term. Now, don't get me wrong. There's bad periods, right? Where you're going to go through significant drawdown. But overall, the idea that you can't hold it long term, if you held it for these 15 years, as I mentioned, that's a pretty long period of time and you would have made a killing. Don't get me wrong, if we see a lost decade, there's going to be problems. But the idea that this is not a long-term holding, it can definitely be held during certain time frames for a long period of time. Now, there is some idea about decay, volatility drag. I explained that in the previous video, but I really want to dive into it more deeply now. And now just a simple calculation first. 10K would have became 1.6 million in 15 years had you invested for that long-term period in TQQQ. But essentially, the research that I reference comes from this article. This is back-tested, like I mentioned, over nearly a century. Yes, nearly a century. It's a Charles H. Dow Award winner. This is no joke. It's legit stuff. If you can't believe this research, this research is purely based on facts. So I don't know what else to say. But essentially, what people think first is they cry about long term. Guys, if you're able to leverage, and this is daily leverage, just like those ETFs, over a period, nearly 100 years, you would have significantly beat the S&P 500 in every scenario. So first, can you hold it long term? Answer is yes. There's no doubt about that. There shouldn't be any doubt. I don't know why anybody would have doubt about that. Now, the main concerns, like I mentioned, volatility drag. Some people call it decay. Whatever you call it. Look at this period. A volatile period where the S&P 500 delivers 0.5%. All the leverage options do worse, with the 3 times delivering negative 2%. Like I mentioned before, when it goes up, you increase your exposure, and when it goes down, you decrease your exposure. Now, that's equivalent of buying high and selling low. Now, you might be thinking, well, isn't that a problem? No, because the market drifts up over time. So you're essentially adding more exposure over time as the market goes up more over time. This is the same thing. Just path depend, volatility drag. A lot of people get really twisted up because of the volatility drag, and it's really not that much of a concern. But better yet, it's actually been proven that the market reacts differently in certain scenarios, say above a select 200 moving average or below. And this is simply because if you've ever observed something like the VIX, the volatility index, you can see that as price decreases, for the most part, you do typically see volatility increase. So we know volatility is a problem. We can avoid volatility. And you might be wondering how. Well, if you were to use a simple moving average rotation strategy long above, flat below, you significantly reduce your drawdown. That in some ways is avoiding volatility. Volatility above is less than volatility below any select average. That's just like market nature. It's human nature with panic. The VIX supports this. And this is over a very long time period, so there's not too much reason to doubt this. The returns above select averages will be more than below. That just makes sense. Same with the VIX. Your worst trading days are below. And it makes sense because VIX is high, right? Like it's very obvious, it's very straightforward. So essentially you're looking at better streaks above select averages and worse streaks below. So one, if you hold for a long period of time, will you beat the market? Yes. Proven over nearly a century. Now, don't get me wrong, you might be in a 30-year drawdown, but will you beat the market over time? Yes. And now you guys might be thinking, okay, a 30-year drawdown doesn't sound very good. And that's true. And then that's why you combine it with some sort of rotation strategy. So you can reduce your drawdown while simultaneously increasing your returns. So essentially, I talked about beating Buffett. And Buffett had nearly a 20% return. This, on the other hand, had you leveraged and paired it with the 200-day average, you'd be looking at a 26.7% return, which is better than Buffett. So I think the misconceptions, I can see why people might get confused. Google search is a little bit misleading, but Google search is just an opinion. Oh, they're not recommended. Oh, they're not meant to be held, right? And there's no really solid reasoning. Sure, they point to volatility drag. Sure, they point to maybe a bit more expense ratio. But really these things, nothing's perfect. Don't get me wrong, it'd be great if somehow this would be a perfect vehicle with no volatility drag and expense ratio just as low as the S&P 500 ETFs like SPY, for example. But the fact of the matter, it's not a perfect vehicle. I'm not going to deny that. But you're looking at a better return than the S&P 500 by far, and even a better return than Buffett. So I just don't really know how you could complain. And the thing is, it's not oh, this is a one-off strategy. I mean, this is nearly 100 years. So once again, how can you really complain? And then the idea that you can't hold long-term, the facts prove you can, even without a leverage rotation strategy. You add that in and it makes the long-term hold better and easier. Now, and everybody defines long-term different. I'm talking over a century. Perhaps you're only interested in the 15-year time frame. I mean, TQQQ over 15 years speaks for itself. That is literally proven. You could have done that, holding from inception until now, and 163 times your money. That's something you could have done, and there's no way to dispute that. That is literally a fact. Now this, you could argue oh, there'd be commission, there'd be slippage. I mean, back then it wasn't possible like it is now because we didn't have those ETF vehicles back then. So you can make some sort of complaints, although this is theoretically based on if we did have those vehicles. But the idea is it's very simple, and you can hold them long term. I don't really know what else to say. If you still think you can hold a leverage ETF long term, despite all the data, the research, the facts, I mean, What else is there to point out? Like the volatility drag, sure, it's an issue, but that's all it is. So yeah, that's it. Like, well, oh, and I guess one last thing, right? Like I mentioned, it's pretty easy and simple to beat Buffett. I still stand by that. And does that mean we should all be richer than Buffett? I mean, no, it doesn't, right? Because some of us are going to be less frugal. I mean, Buffett used an insane amount of leverage, like beyond his personal capital. So there's that. Buffett also has been in the market for quite a long amount of time. So, comparing to us, I mean, like obviously someone in their 30s, even using a better strategy with better returns, is not going to have more money than Buffett. And I mean, there's plenty of people who had much superior returns to Buffett over very long time frames. Not as long as him, but very, very long time frames. And they don't have nearly as much money despite superior performance. So, I don't know. I got a comment that saying like, oh, if it's really that easy, we should all be richer than Buffett. And it's like, well, there's so many other factors, right? Like outside capital, external leverage, time frame. It's ridiculous. Like even if you're annualizing 100% for the next 10 years, you're probably not going to be richer than Buffett. So there's not too much else to say. If you guys do have any questions, feel free to let me know. Like this is a really good paper. I'll link it below. You guys can read through yourself. But questions beyond that, you can always leave a comment. I'll answer. It's just pretty ridiculous when people are denying the basic facts. And I do hope this clears it up because Google search doesn't really do too much justice by just spitting out opinions. And I thought I'd bring the real facts and data in front of you so you can really judge for yourself. But that's all.